Hey, so I wanted to touch base on Amazon. Last time we looked at them was July 24th, so they've had earnings come out since then. We're definitely going to pretty much start with what we expected to see, what they actually did. We'll go into guidance, and then we'll shift into news, just cover what they've been doing for the past about 2 weeks, I would say, and then we'll close out with the technical analysis. But again, yeah, we last checked in on July 23rd. It was trading at 130, which we had as fair value. Now it's at 138. So we'll look to see as we go through this, is 138 a good buy point? If not, what is a good buy point? So let's just get started here. What we expected to see was Amazon to put up about 34 cents for earnings per share and something around like $131 billion. Turns out they crushed those numbers. They ended up getting 65 cents and $134 billion. Uh, so not very close. Normally we see, oh, we're expecting $10 billion. They give us 10.1 and we call it a beat. This one is a rare case where we expected 131 and got 134. That's phenomenal. Um, but let's kind of take a look into just everything that went into that. So the background here, we have just a bunch of things highlighted. Mainly, we have earnings per share, revenue, operating income, just to give us some idea of what margins are. So the biggest change right now in terms of revenue, whether you look at this quarter compared to last year or the full 6 months for this year, because again, this is Q2, is the service sales. Service sales went up about 11 billion compared to this same period last year. And in terms of the first 6 months of the year, it's also grown about $21 billion. In terms of the cost of sales, it actually improved, not by much. For the full 6 months, it's averaging out at 48%. For this past quarter, it was 49, which if you even that out, that means the first quarter was probably around 47. So they improved it here. And if they can continue to do that, that's going to work out well for them moving forward. But again, that 50%, we like those figures. Amazon hits that. It's then you add in all these other costs. Nothing really stood out in these other costs besides technology and infrastructure, which we will be touching on some news that kind of reflects the technology that's going on with the infrastructure. I believe it's a new plant and satellites for space potentially. I don't know if the satellites are in this figure yet, but potentially it might roll into it. But that's the biggest jump in terms of those expenses, going from 18 to close to 22 compared to the same quarter last year. First 6 months also up $10 billion. Overall operating income, we're seeing it put in about the same. This was definitely the better quarter in terms of operating expenses, or the higher quarter in operating expenses. When we look at the overall income, it's like night and day. Last 3 quarters, or last year the same 3 quarters, Q2 put up like 3.3 billion. This time they're putting up 7.6. We're also seeing that in the full half year that they put in so far. It's nearly doubled. That is projected to continue, but we'll get into the guidance more towards the end or middle of this. Other income, that's another big change. In 22, no matter how you slice it, a lot of expense was going into that category. They've definitely pulled back on that this year, this quarter. And then the last thing to touch on is just the earnings per share. Last year they were doing negative. This year they're doing positive. So they just went through, I guess, a growth cycle potentially. Moving on, we do have some segment information. And the biggest change, again, there's, I guess we'll just break it down. So we have the North America division. That's the biggest one. So any type of move in that division, even if it's the smallest percent, is really going to impact their margins, their revenue. And we're kind of seeing that. I don't highlight it here, but I do note that they made 4% margins, which to them in that category is like $3 billion, going all the way down to the bottom, compared to last year where they actually had negative margins. So to go from negative $500 million to now positive $3.2 billion in that one category, that's tremendous. And to look at the full or the 6 month period from last year to this year, it's a $6 billion difference. Again, it's not highlighted, but that is showing, that's one of the biggest improvements here. Uh, International, that potentially can start growing. That's another big revenue generator, coming in at $30 billion of the 134. So a healthy chunk there. They're currently in negative margins there too. If they can turn that around to just get like 1, 2, 3% margin on that, uh, it a lot of it should trickle down and just lead to very good things there. AWS, that's kind of the big complaint I feel like I've seen around so far is AWS isn't growing as quickly. So it's still growing. It's almost set to be like a solid $20 billion in sales per quarter. Uh, Again, it does appear to be growing year over year. It looks like down at the bottom, I believe this is year over year, so like 12%, 14% for that 6 month period. So it's declining. It went from 30% to now like low double digits, and it potentially will continue to do that. But 20 billion seems to be a nice number. Again, I think it'll start just ticking up slightly to 21 to 22, and you'll generally, I think, keep this percentage increase. It's just going to slowly get smaller, but overall growth, it's. And the other thing is the margins. AWS seems to have the best margins. I put it out here at 24%. The thing is, and again, the complaint for this segment is the margins are actually getting smaller. 24 is still like the best margin segment that they have, but I mean, you can just see it on this quarter over quarter compared to last year, where they they received 22 in sales, pulled in 5 as income. Last year they also put in 5, actually a little bit more, 5.7 compared to 5.3, and yet net sales was below 20. So they made 20 or $2 billion more in sales. They didn't bring any of that home. So that's a little surprising. Again, we'll see how that kind of evolves. I think right now the big takeaway is that North America sales, and as long as this stays within that range, 24, 25, we'll just expect that going forward. Another way to look at this, so online stores, third-party seller services, subscription services, advertising, and AWS. Everything's going positive. It seems like online stores have been relatively flat, around like 2 to 5%. Third-party sellers, that is growing consistently around 20% for the past year. Subscriptions continuing to grow, becoming larger pieces of their revenue at around like mid-teens. Advertising, that continues to stay at about 20%, which is a healthy jump. And then AWS, again, that one's starting to shrink, which is not good, but still it seems to be on average in the mid-teens. But that's one we'll have to look out for, and especially if margins are going to start shrinking, we need to be aware of that. But again, it looks like it might just be shifting. It would be nice to have 2 strong revenue generators, but if it kind of balances out, we'll just have to live with it. Here we have statement of cash flow, so handful of highlights, but just to briefly go over them. So operating net income, that was like the biggest difference. We kind of pointed that earlier, that it's just night and day here. Um, Depreciation, that's kind of changed a little bit. Um, 6 month period, it's gone up about $3 billion. Stock compensation, they get to add that back in, it looks like. So they've been issuing that. I, I think there's even, it's kind of hard to read, but down here in the corner, that stock-based comp, it looks like they're allocating a lot of that to the technology and infrastructure. We're also going to mention that in the news section once we get to it. So that's where they're putting that stock-based compensation. Non-operating expense, uh, it was a very large amount last year. Nothing's really happening this year, nothing to add back. Inventories for the 6 month period, uh, it's become a smaller figure. Same with accounts receivable and accounts payable. Receivable and payable, though, that's more just a timing thing. It's just um, good timing one period, bad timing the next period. Net cash provided by operating for this year, 16 billion for this quarter. For the full year, 21. For the trailing 12 months, 61. That one continues to climb compared to last year. So we're liking that. Investing, uh, they're making purchases in property and equipment. I think once we get to the balance sheet next, we'll again kind of see the results of this. Sales and maturities, that changed. It looks like last year they were selling things. This year they're not. Financing, they took out debt last year. No debt this year, so that's good. But now they're paying it back. Moving on to the balance sheet, not much here. Here's that property and equipment though. That has gone up about 7 billion, and I think one of the news articles tells us exactly where that went into this plan. I think in Israel, but again, we'll look at that later. Overall, the current ratio, it's about 1 to 1. Unearned revenues here, so if you take that out, it's definitely positive. Tons of cash, a lot of AP, but again, it's not like it's every day, and it seems good enough. Other assets, that's the only other thing that kind of increased. Not sure what that would be off the top of my head, and they don't explain it, but if we come across it, we will bring that up. So that kind of gives us an idea of what they did in terms of guidance. Relatively good. So as of August 3rd, so they got a little bit of a runway here. So they got to see all of July. And what they're seeing is net sales are going to be expected to be between 138 and 143. Here's our updated Yahoo analyst report. So they're putting in 141 here in the middle for the revenue. So pretty much just cut it right down the center, 138 to 143. They're saying 141. What's also nice to see is the operating income. That's expected to be between 5.5 and 8.5. They mentioned how it's a big beat compared to the same period last year. But in terms of quarter over quarter, if it comes into like 5.5, it's going to be relatively flat quarter over quarter, but still, that's really good operate. And if it comes in on the high side, that'd be even better. This guidance, of course, assumes, among other things, that no additional business acquisitions, restructurings, or legal settlements are concluded. So, not sure if they're hinting at something there, but potentially. So let's just cover this, and then we'll shift into the news. So they updated the earnings. We're expected 58 cents this quarter. Again, they revised that up. This current year, that's what they're projecting. Same with for earnings per share. And right now, it looks like we're probably a little behind on getting to the current year, but if we put up 58 and then a little bit higher, we should meet that. I would assume the same roughly for revenue. But let's get into the news here. So right off the bat, Amazon could face FTC lawsuit looking to break up the e-commerce giant. It looks like the FTC is finalizing its highly anticipated antitrust lawsuit. The complaint is anticipated to focus on challenging practices of the Amazon Prime business and policies the FTC believes force merchants to use Amazon's logistics and advertising services as opposed to breaking those pieces up. I guess giving the person the option to use FedEx services or UPS logistics services versus Amazon. It kind of makes sense that Amazon just offers everything, but I guess they're not giving you the option to do that and pursue potential better deals. So we'll see what the result of that is. Not sure. We'll just have to wait and see. Next, we have the Amazon and iRobot agree to a lower price for acquisition. So I believe this went through. I know it went through the UK, so I believe it's getting closer to finalizing. It looked like they revised it down, so this is good for Amazon. They're now expected to pay $51.75 per share, compared to originally it was $61 per share. And this is due to, it's not highlighted, but it mentions it here that iRobot had to enter into a $200 million financing facility to fund its operations as this deal is going through. That was enough to send the price down close to $10 per share. So overall, again, good for Amazon, I suppose. It looks like they're going to have to take on some debt, which was not part of the plan, but I guess it balances out. Here we also have India's looking to, it seems like, get sponsorship or media rights, it says, for their cricket, the sport cricket. India's looking at either Amazon or Google. It looks for $750 million. Don't know how much that sport costs or how much revenue it can generate, but again, Amazon's looking into it, or at least one of the potential suitors for it. And we kind of mentioned this earlier about the infrastructure technology. AWS is launching an infrastructure region in Israel. This is set to be $7.2 billion through 2037. So I don't know, maybe it was just a coincidence that one category, I think, property, plant, and equipment, went up about $7 billion. That would make sense, I suppose. If they just are allocating that full amount right now and going to pay it off between now and 2037, then yeah, it makes sense, as opposed to, $1 billion here for this piece. Either way, that's definitely where some money's going. So we'll see if that's just like a one and done situation or if it's going to get updated along the way. The fact that it's launched, it doesn't sound like they're building anything, so potentially that is where that full $7 billion is coming from, this Israel investment. We also have Amazon is looking to potentially be an anchor to this ARM IPO. This is SoftBank's ARM. We've mentioned that we are going to be interested in picking this one up pretty much out the gate. It looks like it's ticker symbol ARMHF. Haven't found it available yet, but that's the symbol we'll be looking for. ARM's market might be impacted by Risk 5. That was brought up before. That seems like it might be a competitor for them. Also, ARM plans to list on the NASDAQ in early September, so about a month away. And they're seeking to raise about $8 to $10 billion. I don't know if that's something separate before doing the IPO, or if that's what they're hoping their market value is on IPO. Either way, I guess if that's what they're hoping to get in terms of market value, the one number that just rings a bell is Nvidia tried to buy this company for $40 billion. So even if that's just 4 times the current market value, that seems like a pretty good deal. Of course, we'll have to wait roughly a month to see what actually is the initial offer, but we're looking into that. Here we also have Amazon is set to launch a credit card in Brazil. It's partnering with this lender Banco Bradesco. The launch is set for next Tuesday, which was this past Tuesday. Haven't heard anything since, so I'm assuming that went well for them. Amazon also plans to launch its first pair of prototype internet satellites late next month. This is aiming to complement AWS, their web services. Amazon has vowed to put $10 billion into the satellite internet endeavor, and in 2022 bagged 83 launches to deploy it in orbit, the largest commercial launch procurement ever. So a lot of money is going to go there. I think that goes with the, technology, potentially infrastructure. The satellites, yeah, they're going to put a lot of money into that. So we're aware of it. Last thing before we shift to the technicals. So Amazon, they made a deal to work with Volvo's India JV for 1,000 electric trucks. This is just in India. So that might have an impact on Volvo in India, something like that. Too small, I think, really to impact Amazon, but thought I'd bring it up. And then we also have Amazon scraps private label brands to cut costs. So they're shelving several private clothing brands in an attempt to reduce costs and address antitrust scrutiny. They decided to eliminate 27 of its 30 in-house label clothing division, leaving it with just Amazon Essentials, Amazon Wares, just 3. This one was surprising. We didn't really bring it up in that FTC lawsuit, but if this is lumped into that, that definitely doesn't look good. The fact that Amazon got rid of it is definitely better, but I'm just imagining that means Amazon's, website was using 30 brands that it owned, so it was saturating the market. So all the other companies that were like legit sellers, maybe as myself or like the store down the road, I don't know if they could get through that type of traffic. So if that's part of the antitrust thing, it'll be interesting. We'll see. That's something that probably is going to evolve over time, next month, potentially years, but something we're going to look into. So let's just move on to the technical analysis here. It's time for that piece. Again, last time we looked at this was on July 23rd, it looks like. It was trading at 130, and so that's down here, it looks like, 721. That must have been like Monday or something, 130. So 130, and now it's at 138. So we'll just start updating this. So the buy points we had were 108, which is down here, this green horizontal line. We also have 121. That is just the bottom of the current uptrend, which was part of the note that we left ourselves, is that it's in the short-term uptrend since January of this year. Looking to buy the dips. One thing before we get further is I actually updated this uptrend. I changed the colors. Originally we just had this green and blue line, both purple, just showing there's this uptrend range. But of course lately it's kind of picked up the pace a little bit, or took a step up. So I decided to make that bottom layer green. The previous upper trend of that purple line made that blue. And then I added this third level where it seems like now the new resistance is. And I bring that up because whenever it was at 130, I gave it the fair value rating, because it's starting to dip to the blue line, which again, currently is fair value. But previously it would have been resistance. So I tried to make the picture better for us. And that's kind of all it is. And I'll share this before I update it, but I actually picked this one up at around 130. I did end up reaching for it. The argument at the time was that it dipped down to that blue fair value point. I felt comfortable with the support we were seeing over the past couple months to just kind of go for it, see how it worked. If it pulled down lower, we would just add to it. But that was the thinking, and that's kind of what we did. So currently 138. It looks like we thought there might be some resistance at about 135. That was not the case. It looks like we just picked that out due to it getting rejected there in 721 just before we did this, or did the last check-in. Looking back further, there was a little bit of resistance there. Again, so not much. That's why it was such a faint line as opposed to a thicker line, but we still marked it. So that we'll keep it in for now. But so the buy point of 108, again, there seemed to be decent support there going back into 22. Not much else. I guess a little bit more here in later 22. That's pretty much all for that. We also have 121. Looking at 121, a part of me wants to put in this one line here. It looks like it found a little bit of support in this area. I'm going to mark that green. I won't make it the strongest line, but just a faint line to show some support was kind of found at 129. So I guess to pick a buy point, 129, it's still in play for me. It's kind of getting far, especially if it stays between that blue and red line. But 129, that's within play. That might be my ultimate point. A pullback for this, if we just go out till next week, a pullback could be 135 potentially, and so not much different, but 135 would be like the first time I'd even consider it, I would say. 135, 129, and then ultimately, if it pulled back to like a 120, that would be great too. So we'll just tag in a couple lines here. We'll put in 135. That would be the first price I would consider it, 135. 129 would be even better. And then if it pulled back all the way to the bottom of the range at 121, that'd be great too. I think we're getting a little too far away from 108 to keep it in. But 129, that's the point I'm waiting for right now. 135, I would consider it. Resistance, we thought it might kind of struggle at 135. It ultimately didn't. So I guess we'll keep it in, but it's not my resistance point of interest. Really, it's like 167. So we have this blue line in here at 167. That's like the next like strong resistance point. And I have it being blue because it does kind of act as support a little bit. I'm just going to update it to red just so we avoid confusion. But now that I'm seeing this a little more clear, that's another reason why I chose to reach a little bit at 130, is the fact that once it gets through 134, which there wasn't much resistance at the time, still isn't, I felt like this one could take off, especially after strong earnings. There's not really resistance until 167. So yeah, it might continue this uptrend, but it could also pop, and nothing would really slow this down to 167. So I felt like there was a good ratio where, again, I was willing to reach because I felt the potential could be this one could quickly go to 167. And so, yeah, that was just the thinking. We will continue that thinking here. But again, keeping modest, I would say. So resistance again, 135. Slight resistance, not much. 167, that is still a strong resistance point. I didn't pick this one up. I showed you that I picked it up last time we talked about this. I'm updating the dates. The earnings, we went through that, so I'll update that shortly. Overall, the short-term uptrend since January, that is still in play. In terms of like a buy score, it's not crazy. It's like the ideal spot right now to be fair value would be 133. It's at 138, so yeah, it's a little high. I, so I'll give it a red. I have no intent. It would have to pull back close to like $8, so that's a decent jump. Um, but yeah, that pretty much wraps this up. So just a quick recap. We have Amazon here in red, meaning I don't like the price right now. The buy points I do see are 121, 129, and 135. 129 would be the number I'd be most interested in picking it up. 135 I would consider it, but 129 is like a true number I'm looking at. Resistance at 135 and 167. 167 looks like what I'm most interested in. Nothing's really slowing it down between now and then, so not until 167 would I be like, what's it going to do? We updated the date, the earnings. That date will be updated soon. And then that note, the short-term uptrend since January, that's still in play. Buy the dips. That's still how I'm treating this. Uh, so yeah, if you have any questions about something I went over, by all means, feel free to ask. Or if you have any comments, I'd be happy to read that. Otherwise, that's it. So please like, subscribe, and I'll see you on the next one. Bye.